Good afternoon, everybody. Thank you for joining us today. Welcome to another edition of our self-directed IRA Saturday. My name is Andrea, and I'm an IRA specialist at Quest. Beautiful day out here in the city of Houston, Texas. I hope you're having a great morning so far. You can tell us in the chat where you're joining us from. We have a great presentation today, great show. We have John and Patrick with us here. They're going to be talking about opportunity zones, tax incentives. Super excited about what they have to share with us today. Before we bring them on and get on with their presentation, so I'd like to go through, a couple housekeeping slides as always. So starting with our disclaimer, we do not provide any tax, legal, or investment or structuring advice or endorse any products, services, or investments of any type. All information and materials shared here today are for educational purposes only, and all parties are always encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments, okay? I'd like to share with you guys our November promotion that we have going on. When you open an account with us in November, Quest is actually going to be paying for your first investment. So you're going to get a credit of $125 to kind of get you going and to help you with the very first investment there. So go ahead and take advantage of this promotion. If you'd like to schedule a consultation with an IRA specialist, there's a group, it's a great team of about 7 of us. We're always happy to answer your questions, to take you through the process. Anything you need, we're there for you. If you'd like to schedule a complimentary consultation, go ahead and scan this QR code. We'd be happy to help you there. Rental Continuum, I think this was done already. Great turnout there. Networking events in all of our offices. This one was yesterday too. And I want to thank everybody who joined us yesterday. It was awesome. Great turnout, and our speakers were amazing too. So all in all, a great show there too yesterday. But then we have our Quest Expo coming up next year that we're already selling early bird tickets for. This is the place to be if you want to learn more, if you want to have do networking and get to meet other investors, get to meet people who have projects. There's going to be a lot of sponsors there as well. Last year when we did it, there was upwards of 750 people. We're expecting next year to have at least 1,000. So it's going to be huge. It's going to be in Irving, Texas, which is in the area of Dallas. Scan this QR code so you can grab your early bird tickets. And can't wait to see you all there. But that's all I have for you guys now. So let's bring over our John and Patrick, our speakers of today, so that they can get started. Hi, John. Hi, Patrick.
Hi.
Welcome.
Thanks for having us on today. We're excited to be here.
Thank you for being here. Yes, go ahead and take it away, guys.
Wonderful. Well, good afternoon or good morning if you're on the West Coast. I'm John Burlett. My associate is Patrick Segru. I'm based in Rockport, Texas. And I'll tell you a little bit about, we're going to go maybe 30 minutes or so and have some Q&A here toward the end. The subject, of course, is opportunity zones. Really excited to share with you what I've learned. And then Patrick will go over a lot of the compliance issues. And he's really one of the nation's experts in the subject. He's a practicing attorney based in Michigan. And he also serves on our advisory and business council for the Coastal Bend OZ Fund. So again, that's who we are. We're real happy to be presenting here. In addition to Andrea's disclaimer, nothing we say is intended to be legal or tax advice. I encourage you to consult with your professionals on that front. So I'll start with just briefly my background and how I learned about opportunity zones. I had a financial planning firm, a registered investment advisory firm based in Austin, Texas, for a little over 30 years. And my focus was on retirement income planning, tax planning, Roth conversions, self-directed IRAs. In fact, I'm considered a pioneer in the self-directed IRA space, having started my first self-directed IRA with a company called Sterling Trust, which has been acquired, and they're out of Waco, Texas. But in 1993, I figured out how to buy tax deed properties at the courthouse steps using my small self-directed IRA of $26,000, which I then parlayed and learned a whole lot about. So I love real estate. I have a passion for real estate, but my focus, my business is on retirement income planning, safe money. And I sold my company in March of 2021, right in the thick of COVID. If y'all can kind of think back with me, everybody was panicking. The world was upside down. March of 21, I was able to, after 5 months of diligence, sold my business, or a big chunk of it, resulting in a capital gain event for myself. So what did I do? I've been hearing bits and pieces about these opportunity zone, new tax incentives that came out of the 2017 Tax Cut and Jobs Act, weren't fully, I guess, certified by the IRS until 2018. So I bought a motor home. My wife and I traveled 17 states looking at these geographic opportunity zone locations, and ended up purchasing an old property in Rockport called the Oleander Courts. And we'll tell you a little bit more about that project. But at this point, I want to turn this over to Patrick and ask him to briefly introduce himself and then go over our agenda for today. These are the key points, and go through his material. Patrick, so turn it over to you, sir.
Thanks, John. I am Patrick Shagru, as John said. I'm in Grand Rapids, Michigan, although my background is actually in Texas. I spent last week in Houston for half the week and half the week in Rockport, Fulton, actually with John, getting a great tour of the area, which is an opportunity zone, and doing some business. So I love Texas. Got family there, and pleased to be on the program. Andrea and John, thanks for the invitation. I've been practicing law for over 35 years. My undergraduate degree is business finance, so I've always had a business and financial trend to my practice. I worked a lot in from the business side in what we would call alternative capital or private equity capital, and stock offerings and things like that for businesses. And on the investment side is what we've come to know as alternative assets. So a lot of high net worth individuals would either create funds or themselves make investments into real estate projects, energy projects, certain projects, and invariably people are looking for tax benefits associated with those types of investments. So when, as John mentioned, in the Tax Cut and Jobs Act of 2017, which became effective in 2018, myself and geeky people like me looked through that act and found this provision on qualified opportunity zones. And both from the standpoint of businesses seeking capital, but also investors doing alternative investments, it was like, this is the holy grail of tax benefits, which also has really positive results from a policy standpoint in terms of economic development. So I went all in. Even as John said, they actually didn't write the regs or adopt them, the regulations. The law is only like 4 pages long. The regulations are hundreds of pages long, and they weren't fully adopted until 2020. So it was kind of slow out of the box to get practitioners, investors, and wealth managers comfortable with this, and it's still happening. But it is something to note. John, could we go to maybe the next screen? Yeah. The idea of what they are trying to do with this provision of the act and tax legislation was to respond to this map, which shows by the color coding a disbursement of economic distress throughout the country. There are pockets where areas of population are really just distressed. They're less than 25% of the median income and wealth standard. And that sort of disbursement was what sought to be addressed by economic think tanks as well as certain people in Congress. And that's what resulted in the Tax Cut and Job Act provisions for opportunity zones. So what they did, and I don't, people have varying degrees of understandings and familiarity with this project, with this provision. It's quite complicated, unfortunately, but it is a product of the IRS, so understandable. And for this audience, in terms of self-directed IRAs, it's important to understand what an opportunity zone investment is and what it is not. It is not, and John and I had a long discussion about this just yesterday, it is not really a seminal classic investment for a self-directed or any IRA, be it a pre-tax IRA or a Roth. It really is more needs to be thought of by IRA folks that use IRAs and solo 401ks or 401ks for tax planning, to be thought of as another tool in the tool chest for assets that aren't really suitable to go into your 401k or your IRA. So it is also not something that will allow an investor to make a tax-free investment and not pay any tax on something that otherwise would have a tax in it from the start. So it's not like like municipal interest. It really takes an investor's capital gain from a transaction, any transaction. It could be sale of a business, sale of real estate, sale of stock, sale of Bitcoin, any capital gain, and seeks to have that investor incentivize them to invest it in a qualified opportunity zone investment. And that qualified opportunity zone investment will have a lot of touching points to those distressed areas, the census tracts identified throughout the United States that are eligible as qualified opportunity zones. So if you can go back just a second, John. Yeah. So the investor will have to pay tax on the amount that they invest in their qualified opportunity zone investment. It's deferred, the tax is deferred, but it has to be paid by all opportunity zone investors by the end of the tax year 2026. So sort of the chickens come home to roost in the April 2027 tax return, and all gains deferred by original investment are due for the capital gain tax, but there are additional benefits associated with the program. So another, just what an opportunity zone investment isn't for businesses that receive the investment. It is not tax-free money. And just by being a business or having a real estate project in an opportunity zone does not give you any tax relief. It doesn't give you a tax credit. It just makes you eligible to receive this money coming in from private capital, from those investors who make opportunity zone investments, and they happen to have to look for compliant investments, and you might happen to be one if you're a real estate project, real estate developer, or an opportunity zone business that is creating economic development and activity in an opportunity zone that you operate in. So it's gained. The policy of the whole thing is geared towards improving historically economically depressed opportunity zone census tracts chosen as opportunity zones, and it's got to be a long-term hold in order to get the tax benefits that we'll talk about in just a second. Okay, John, sorry. All right. One thing to keep in mind is if an opportunity zone investment is made, it doesn't negate other tax incentives that would go along with for the investor or the business with the opportunity zone investment. So tax credit investments, new market incentives, historic, affordable housing tax credits, other types of things, all still sort of are available and create sort of what we call a tax incentive stack to a business or opportunity or a real estate development opportunity. You add now to it opportunity zone investments. As I mentioned, they're all over the country. They're originally nominated by the governors of all the states, and then the IRS approved the ones that the governors nominated in their states, and so they're dispersed throughout the country. Next slide, John. You can see in Texas, in every state, they are dispersed according to where the governor thought, you know what, this area is economically distressed as a census tract or group of census tracts. But there's reason to believe it could economically develop for the benefit of the population and for the businesses there if we targeted this as an opportunity zone to collect opportunity zone investments. So Texas has a bunch of opportunity zones denoted by the pinkish color on the map of Texas here. Next slide, John.
Yeah, let me jump in. In fact, the largest area is around Houston, with, I want to say, well, they have the largest percentage of census tracts designated, and then the valley here, the Rio Grande Valley, has the second most. What I decided to deploy my gains is in this region here, the Coastal Bend region, and I'll tell you a little bit more why. This is Rockport, and this is Aransas County, all this area. To the south of us is Corpus Christi, and there's a county between Nueces County and Rockport, for those of you in Texas, called San Patricio County. 85% of Aransas County is designated opportunity zone, yet only about 5% of this county. It's because so many jobs, and the real dynamics going on here along the coast is there's so many what's called second homeowners who report their incomes throughout the hill country, Austin, Houston, San Antonio. So the residents here are, in fact, in the lowest 25% income census tracts. I'll turn it back over to you, Patrick.
Okay. Thanks, John. And again, it was a pleasure to be down in Rockport Fulton area to actually see that opportunity zone this week. So again, just the regulations create sort of a complex structure that every one of these investments has to sort of abide by. It starts with a taxpayer that is looking for deferral on an unrelated transaction, a prior transaction. As I mentioned, it doesn't have to be sale of real estate like a 1031. But it can be capital gain generated in any way. A lot of times we're seeing it with sales of private businesses. And then the next step is the amount that the taxpayer seeks to defer in that initial deference of the capital gain that he's looking to invest, he or she, or it, if it's a corporation. It'll go into this vehicle called a qualified opportunity fund, which is really a special purpose vehicle set up in this legislation to collect the qualifying investments for disbursement into the actual investments to be made. And that the investments to be made by the qualified opportunity funds are qualified opportunity zone property. And that property can be actually direct real estate equipment or tangible property, intangible property held by the QOF, Qualified Opportunity Fund itself, or as is become the best practice, the QOF will invest those funds in what's called a qualified opportunity zone business. And the business investment in the business itself, assuming it qualifies as a qualified opportunity zone business, will be 100% a good qualifying asset for the qualified opportunity fund. But this 1-step, 2-step, 3-step, think of a waltz, that's an opportunity zone investment. Next slide, John. So again, I mentioned that the tax incentives really start with this gain, which in 2018, if somebody made an investment, an opportunity zone investment in 2018, that was a good thing because you got a gain deferral through the 2026 tax year of the amount that you invested. You also had a second benefit that if you made that investment, that original investment that you sought to defer gain on until the end of 2026, and you held that for a minimum of 5 up to 7 years, you actually got part of that forgiven by a basis step up. Well, we're now in 2023. It's impossible to hold an investment for 5 years until the end of the 2026 tax year. So that basis step up and the partial deferral, which would have been up to 15%, is no longer available. But don't turn the dial. The big incentive here, and the reason that this is really revolutionary, is, again, the legislation is trying to drive long-term investments into these economically distressed areas in business development and real estate development. They're looking for long-term holds. So the tax incentive is if you hold your qualified opportunity zone investment for a total of 10 years in a compliant way, and then exit after 10 years, If there's any appreciation beyond what you originally invested and paid taxes on at the end of 2026, if your investment appreciated in that the balance of that holding period to a total of 10 years, the rest of that appreciation when you exit, as long as it's before 2047, is completely forgiven. It becomes tax-free. That is significant. And for those investing in real estate, which is a big part of opportunity zone investments, private real estate investments, or even big time real estate investments, they're actually, not only is the gain, the additional gain forgiven, but there's no recapture of that gain towards ordinary income. No recapture, which would otherwise be the case in a real estate development project or a passive real estate alternative asset investment. So that's really huge in that area. Next slide, John. And this just kind of outlines the steps of that, what we call big enchilada, which is that third benefit of a complete exclusion of additional gain after a compliant 10-year hold of a qualified opportunity zone investment. It's really what is motivating all of the activity. Next slide, John.
Yeah, let me clarify real quick on the huge incentive of no recapture of the depreciation. So in essence, you know, it's like any other real estate deal in the fact that you can take advantage of bonus depreciation, accelerated depreciation, but within a eligible capital gain investment and a QOF, all the appreciation you get out totally income tax free after 10-year hold, but you do not have to recapture those depreciation that you enjoyed throughout the holding period.
So thanks, John. That's an excellent period, and what's motivating a lot of the activity we have seen is in real estate development. A lot of affordable housing, a lot of housing redevelopment, a lot of hospitality projects, and mixed use and whatnot is being developed in opportunity zones, and it's good to see. Again, I just wanted to remind people there's that intermediate step of having to make sure that the investment goes through what's called a qualified opportunity fund, which can be either a managed fund, like a professional fund manager can, and they do set up opportunity funds that a passive investor can invest in and thereby defer their gains and get that gain exclusion after a long-term 10-year hold. Or it can be a self-directed qualified opportunity fund where just a family office or whatever decides that they want to defer their gains and control all of the investments of their funds into qualified opportunity zone investments. Next slide, John. Okay. Yeah, this slide we're gonna skip, and it'll be available with a lot more detail on this stuff in the materials if anybody wants to get the slides. Okay, there was one that I was going to mention, but let's go through at this point an example of what actually would happen with an opportunity zone investment. Let's assume that in 2010, this is way before the Tax Cut and Jobs Act, a taxpayer invested $1 million in Minitech stock. It's a little startup. 2022, the investor sells the investment in Minitech, did really well, $3 million, resulting in a $2 million capital gain. So that's a capital gain resulting from a private stock transaction. And the investor is looking to perhaps see what incentives are available to them. So the 1 million of the sale proceeds of the Minitech stock is going to be recovery of basis and is not taxable. If the taxpayer wanted to continue to defer the gain portion of it, within 180 days of selling that Minitech stock, invest in a QOF, an opportunity zone investment, now that taxpayer is on the road to deferring that $2 million of gain at least until the end of 2026. Next slide. So, no, this one, yeah. So the QOF will then invest the amount invested by the investor in that special purpose vehicle into, let's say, another opportunity zone business. So $2 million, the amount of the gain, is invested in the opportunity zone business by the QOF. In April 2027, as I mentioned, the original $2 million of gain that was deferred through the 2026 tax year is due in taxes on your April 2027 tax return for the 2026 tax year. The QOF continues to hold the stock, let's assume, for 10 plus years after paying that tax bill. And let's say in 2023 or 2033, the Opportunity Zone business is acquired by Megatech, resulting in $10 million for the QOZB stock in Megatech. The taxpayer will, in that transaction in 2033, pay no additional capital gains on the sale of his stock. And if it had been a real estate project, there'd be no depreciation recapture in that investment. That's kind of an example. And we in high growth stocks or high growth real estate projects are really good candidates for Opportunity Zone investments. And here's a slide that gives you, if you're looking around for things that you might be investing in outside of your self-directed IRA or 401k, these are the types of investments that you may want to think, hey, could this qualify as an Opportunity Zone investment? And I'll just refer the audience to take a look at those slides. And again, want to remind you that other tax incentive provisions continue to apply in addition to the Opportunity Zone program. Qualified small business stock, 1031, new markets tax credit, et cetera, et cetera. Next, John. We'll also include in the materials, I won't go through this now, but the Opportunity Zone tax deferral and tax exclusion benefit is really adds a lot of incentive beyond what would normally be in a 1031 exchange. I'm sure many in the audience have done real estate investments and have utilized 1031 exchanges, which allows deferral of taxes in the sale of one investment property to roll it into another. And that deferral continues until it's not an exchange into another property any longer, at which point the tax is due. And the only way to really get an exclusion of the taxes in a 1031 rollover program is to die and get a basis step up. Where in the Opportunity Zone investment, again, you're not limited to real estate in your gain investments. And after a 10-year hold, you get that gain exclusion without recapture income. There's some resources included in the slides, which we'll refer you to. There's a lot of resources available, and I encourage people to just Google the subject matter area. There's a lot of information available. It is complex. We definitely recommend working with your accountants, attorneys, estate planners, and wealth managers if you're considering an Opportunity Zone investment, because not only do you have to get in right, make sure it's a compliant original investment, but then there's that holding period that you want to qualify for, where the entirety of the investment continues to qualify as a Opportunity Zone investment. Here's some materials, but there are many others, and John and I will always be available as a resource to you if you have any questions.
Awesome. Thanks, Patrick. By the way, Patrick's available. We'll be sharing his contact information if you want to reach out, connect with him. And he's a great resource. He really knows, as you can tell from that presentation. I'd like to do, before we wrap up, spend a little bit more time on the project that I'm launched and the fund that I created in Rockport. And the project is called the Blue City Paraiso. Basically, it's a mixed use, third story rooftop lounge, full service boutique hotel, spa, and conference center. I'll tell you why I'm settled on Rockport. Those of you who are in Texas, you probably get Rockport. You know where it is. Certainly, if you're in the Houston, Austin, San Antonio area, you know Hurricane Harvey made landfall here in August of 2017. And about 50% of the structures were destroyed, including our courthouse, city hall, and the arts center. We're going to be building with ICF construction, insulated concrete foam, to help manage that risk of the next hurricane. I'll tell you real briefly, we call this, Texas is huge on the radar as this triangle, Dallas, Houston, San Antonio, as far as amount of huge growth taking place. It's primarily Dallas and Houston, but certainly Austin. I grew up in San Antonio, And of course, I was familiar with Port Aransas. Most people in Texas know Port A. I call this the triangle, Austin, Houston, San Antonio, because we're less than a 3-hour drive and a top tourist beach destination 5 years running by USA Today. So this is a picture of Rockport. We have a very clean, mile-long private beach. It's the #1 tourist attraction in Rockport. This is the harbor at Rockport, and then this is being updated as new bulkhead on this area here. We're just 30 miles north of Corpus. For those of you who don't know, Corpus is 7 quarters running right now, the top shifter of energy in the world, right here in Texas. So there's a quote from a gentleman with Texas A&M, economic professor here this year, who said, all the talk about a pending recession is certainly possible, but it won't be felt in Rockport. Totally unbiased third-party endorsement. Our feasibility study has been performed. I won't spend any time because this is not a promotion, more today about our fund. But if anybody's interested, we do have about half our investors are using their self-directed IRAs or Roth. In fact, including myself. I have some clients. You all know this little Quest Piggy. If you're a customer of Quest, you're familiar with this. I personally manage a couple self-directed IRAs through Quest and some other custodians as well. So I love Quest. I love them for many reasons. They're very user-friendly. They have a lot of education on their website, and I encourage you to do business with them if you're in that market space with a solo 401k, a Roth conversion, or any kind of IRA. I'll just cover 2 more slides to kind of emphasize why I decided to deploy my capital gains here in Rockport. This is a chart showing the trend of the 2% of the hotel occupancy tax that's collected by the chamber that's spent for promoting Rockport Fulton. 2017, that 2% almost equaled $500,000 that was dedicated to promote tourism. And really, it's the only industry the community wants here in Rockport. They don't want the refineries, the chemical plants, and all that stuff that's just to the south of us. The community is really focused on tourism. So in 2017, the year Harvey made landfall, that revenue was $475. Of course, Harvey and the visitors, weren't coming here after Harvey. And you can see 2020, it started rebounding. But 2021 and 2022, that number has just totally surpassed all prior revenue as far as hotel occupancy tax. And what that equates to in dollars and cents is almost $36 million in hotel revenues, which includes Airbnb type locations. So here's a rendering of our location. We are about 60% along on our construction drawings. We have the site permit already issued and 62 doors. Love to share more with anybody who might be interested. I'm going to skip through all this and want to thank you. Open this up for some Q&A. If there's any questions in either the chat box, or I don't know if Andrea, if you want to turn that over to a live mic Q&A session, we're happy to address any comments. Do we have any at this point?
Yes. Thank you, guys. That was awesome. Thank you for all the information. I personally wasn't aware of this opportunity zones, so that's really interesting. We have, and Patrick, we're going to post your contact information in the chat, if that's okay. If
Yeah.
wants to contact
Let's go back to I guess the first slide.
Yeah, that's fine, Andrea.
Okay.
Yeah, I'm having a little trouble right now connecting so I can post it. If you could do that, that'd be awesome.
Yeah, I just did. So thank you guys again. We have a question so far, just one. I mean, we're waiting for people to post their questions if they have any. But Elizabeth was asking whether you have a CPA or tax attorney who knows this program.
Patrick, I'll let you address that.
Yeah, There are CPAs and attorneys and some financial advisors that know this program. Unfortunately, there's not as many as there needs to be for, I think, who could take advantage of the program. So we're constantly in continuing education for accountants and attorneys in the space. But yeah, John and I are both cohorts in some trade organizations and networking groups in opportunity zones. And so we have come across colleagues in Texas and elsewhere that are familiar with these programs. And as I said, one thing we do in our practice, we're a boutique practice, all business transactions, a lot of it is tax advantage, is we like to join the client's existing team into the planning of an opportunity zone investment or development, so that we can make sure that all sort of aspects of advice for the client are aware of and can contribute and sort of weave the fabric of having an opportunity zone investment be both compliant to achieve the tax benefits and also work in the overall estate wealth and tax planning for the client. So yeah, if anybody needs a specific referral in a specific area, be happy to reach out to me, and I'll be happy to do the best I can on that front.
Awesome. Sounds good. Thank you for that. Elizabeth also asked, can you send this presentation? And I mean, you could probably reach out directly to John and Patrick for theirs, but just so you know, Elizabeth, all of these videos are posted on Quest's YouTube channel right after. So right after we finish this live, it'll be posted on there if you want to rewatch it and if you want to take a look at the slides again, okay? And then there's another question that just came in from Nick.
Real quick, Andre, I'll just say for anybody looking for more resources, I mentioned there's a lot out there, but rather than fishing through Google, John and I can both steer anybody in the group to a lot of educational videos, programs, networking groups that are free and they're educational, and happy to do that as well.
Great. That's awesome. Free is always nice. Nick is asking, can I take advantage of an opportunity zone through a single family purchase? Does that property need to be an opportunity zone business that could be an LLC I create? And then he also said multifamily.
Yeah. So to answer that question, the original capital gain can come from any capital gain transaction. If it happens to be an investment property or sale of stock, it doesn't matter what it is. But when the opportunity zone investment is made into the QOF and then the QOF into the project, that really needs to be what's called a trader business. So buying your own personal residence would not work. Buying short-term rental properties or developing short-term rental properties would work. Mixed use absolutely would work. Startup of a tech company would work. We've got folks doing software development. We've got folks running hospitality projects, but it has to be viewed by the IRS as what's called a trader business, not strictly a portfolio of passive investments.
Is it correct, Patrick, someone could build single-family homes in the opportunity zone?
Yes. Now you're in the business of being a developer.
But there you have the 10-year hold. So you would want to build and hold.
Well, there is a 10-year hold, and we spend a lot of time in the practice of opportunity zone investment management dealing with operating businesses. Oftentimes they have like if they are developing lots or a real estate development, they're exiting properties before the 10-year hold. We do have strategies that are developed by practitioners to deal with that gain, and you can actually roll it into another opportunity zone investment. You might have to start your holding period over for that portion of it, but there are ways to continue to use this program to roll through your tax incentives. So yeah, we spend a lot of time managing that, John.
Great. Good question.
Yes. We have another good question from Bob Sand. How long from now will investors be able to enter the fund, and what's the minimum investment?
If you're referring to our fund in Rockport, Coastal Bend, We have a minimum investment's an easier question. That's 50,000. You must be a accredited investor, and the deadline is looking like end of Q2 next year. So we have a pretty much a 5 to 6 month window at this point, is my best guess.
Yeah.
Awesome.
Let's address it on a broader scale. Go ahead, Patrick.
Yeah, no, I just wanted to reemphasize what you said. To date, and this is not unusual in an Opportunity Zone program, they will accept QOF, Opportunity Zone investments, but also they're structured to take in investments that are not QOZ compliant necessarily, even though the project is in an Opportunity Zone. So as John said, he's got a good percentage of his capital is coming through investors investing with their self-directed IRAs or 401ks.
Another part of this question you might address real quick, Patrick, is that what happens in 2026 with this program nationwide?
Well, right now, that's the last date that you could actually, the end of 2026, before you can make a compliant investment, because you have to make the investment and defer the gain through the end of the 2026 tax period. There's pending legislation. It has support on both sides of the aisle. There's really no serious opposition to it that would extend this at least for a couple of years, because it took the IRS so long, the Treasury Department, to write the regulations. And if the rest of what's going on in Washington and the election can pass, I'm confident that it will be extended, but it hasn't yet. So this program will end for new investments, new Opportunity Zone investments, at the end of 2026. Now, it'll continue on for your deferral of the investments made in that prior to 2026 year end, and the exclusion after a 10-year hold. So the program continues, but no new investments unless they do adopt that new legislation, which will extend it.
Great.
Yeah.
That's important. I hope that answered your question, Bob.
Yes, and then Bob also had another question. Will the EOZ fund have just a single project, or will eventually have multiple projects? And I think this is, again, referring to your specific project there in Rockport, John.
Yeah. I can answer that. We have two properties right now. Our total focus is on the Blue City Paraiso, the boutique hotel, spa, conference center, and rooftop lounge. However, we eventually plan on scaling it to a couple other locations, as well as get into the mixed-use multifamily space once we get this anchored and up and running and profitable.
Excellent. And by all means, Bob, go ahead and contact John directly as well. He has his contact information up there. Then we have another question. Are there funds that are open to non-accredited investors that you guys know of?
Most of them, because again, you see this with alternative asset real estate projects a lot. They're only open to accredited investors. A lot of these projects. There's one publicly traded Opportunity Zone fund. It's called the Bell Point Green Fund. You might have seen it on TV. It's advertised on TV, and that is not. It's number one. It's publicly registered, publicly traded, which is like unusual when you're going to hold for 10 years. But they did it for a reason, because nothing else like that exists, and they already had the apparatus to do it, and you don't need to be an accredited investor. So look at Bell Point. BELLPOINT REIT. I think it's REIT. They're up in New England. They do real estate development. They're a good firm, and they're one. There may be others that take non-accrediteds, but they will all be private funds looking for that long-term hold.
Yeah, I'll also add to that, Nick. We started a Coastal Bend OZ Fund as a exempt Reg D 506B as in boy, that was available to non-accredited. So I'm sure there's others out there. The reason we switched to Reg D 506C is it allowed us to begin to market and advertise our offering, which comes with that stipulation you had to be an accredited investor.
Yeah. Let me just add to Nick's question. This is really important. A whole bunch of, in terms of the number of transactions in Opportunity Zone investments and funds and whatnot are what we call self-directed. So we have situations where a family would put together a fund, which may be 3 or 4 people in the family in the LLC. They would invest their gain, and then they would seed like family members start up business. And so in that case, you don't need to worry about an independent fund manager, SEC compliance or whatnot. You're dealing with your own family, your own self-directed group, and you can literally have the apparatus set up where it's all self-directed through your QOF into your QOZB, which can be another family business, and you don't have to worry about accredited investors there.
Good point. Good point there. Thank you. Nick says thanks too. So
You're welcome.
we have one more question here from Janine Stewart. Would this work if I wanted to buy property for shared housing? For example, Golden Girls type. I'd like to set up housing for disabled but independent.
Yes, as long as that's a business, which presumably it would be. You always want to organize your business activities that have potential liability in a business. Absolutely. That would be affordable housing. Housing that has care associated with it are kind of one of the areas that they were really trying to stimulate investment into in these areas, because they didn't exist or didn't exist in enough quantity in these opportunity zones. So I think, Janine, that would be, again, it's structured as a business. You run it like a business. It would be an opportunity zone business, yes.
Patrick, do we have time to go into the 90-10 to 60 or 70-30 part of that?
It'll be in the slides that we'll give, the expanded slides, if you contact John or I, all of that. But yeah, opportunity funds, the gathering vehicle, the special purpose vehicle, is going to be tested by the IRS every year in your tax return during the holding period. And it's going to make sure that at least 90% of the assets in the opportunity fund have been deployed into qualifying opportunity zone businesses or business property at all times. And that's a compliance issue. And if you don't meet that test, there are penalties to be paid to the IRS. For the opportunity zone businesses, which the funds, that's why the funds like to invest in opportunity zone businesses, because the entire investment in the business becomes a compliant asset for the fund. The business, though, has a much more lenient test in terms of its assets. Only 70% of its assets have to be qualified opportunity zone property. And so there's 30% that can be used for working capital, for investments and other things. In fact, there's a lot of flexibility for opportunity zone businesses to use capital as startup capital, development capital, as long as you follow the regs and develop. There's even what they call safe harbors for reasonable working capital. And we can help folks to learn more about that or even structure those deals. That's what we do.
Yeah, I would encourage anybody that has the slightest interest to don't let the complexity deter your diligence period. Look into it, learn all you can. It's a huge tax incentive, in my opinion, and I've heard others in my peers say it's like 1031 exchange got married to Roth IRA and they had a little kid named Oz.
But I really like Janine's idea about using it for shared housing for folks that need support services. I think that would be an awesome use. Now, it has to be compliant again, but we talked about those things, and happy to talk more if it's necessary.
Awesome. I have one more question from Nick. A bit of advanced question here, but is it true that improvements of equal or greater value are necessary to take advantage of all the tax benefits?
Yes and no. In some cases, for property to be called opportunity zone business property, it has to be acquired after January 1, 2018 by the business, acquired or leased by the business during that period of time. And if it has already been placed in service in the opportunity zone prior to acquisition by the business, then it needs to be called substantially improved. And substantially improved means you have to invest an amount of money in that asset, that opportunity zone asset, that will double the tax basis of it. Now, if it's new construction, that doubling the tax basis does not apply because there's no requirement to improve raw land. Excuse me, to double the basis of raw land. You just have to make a material improvement in that raw land. So it was a great question, Nick. You've done some homework on this, but only if you have an existing, for example, real estate structure that was acquired by the Opportunity Zone business, and that structure was placed in service, that is depreciated prior to the time that the Opportunity Zone business acquired it. Then you would have to double the basis of the structure, not the land in that case.
Makes sense. Thank you for that question, Nick, and for your answer, Patrick. And then Elizabeth's asking, probably you, John, what's your exit strategy for your hotel? Do you manage or sell in a number of years?
Well, great question, and thanks, Elizabeth. We do have an exit strategy. We will hold for 10 years, and then we do plan in our business pro forma. We have a cash out refis for year 3 once we're up stable and have some distributions to our investor LP partners. So we're going to hire a existing management. We have letters of intent from operators in the boutique management hotel space. We don't intend to manage it internally. We'll certainly bring on a management firm.
So, John, you have a refi strategy to give a cash out refi to investors to perhaps give them some money back from what they had to pay in taxes if they had Opportunity Zone investment. But then the exit refi, you've already thought about potential buyers in that space of boutique hospitality, which is what you're in for a sale exit.
Yeah, and did I mention that our target is 53% of the basis, the investment, to be returned, and that doesn't violate any compliance issues to do a cash out refi. Our business model is 50% cap equity and 50% debt, so we feel like we'll have room even in today's unknown future.
And let's just hope interest rates go down a little.
Yeah, exactly.
Yes, exactly.
Question.
Well, unless you're holding a lot of interest-bearing instruments in your self-directed IRA.
Mm-hmm.
For sure.
That's a good thing.
Any closing remarks, guys, here before we close it off that you'd like to say to our audience?
Yeah, I'd just like to say thank you, Quest Trust, and I love what y'all do for people who are exploring the self-directed IRA space. It's a great tool to diversify and get some of your holdings outside of the volatile stock market.
Yeah, I'd just like to echo that as well. Self-directed IRA, self-directed 401k are I would call the primary tools of tax advantaged retirement planning. Think of Opportunity Zone investments as kind of sort of the frosting on the cupcake or the cherry on the cupcake in a case where you want to maybe do something good or participate in development of a community that you have an attachment to that happens to be an Opportunity Zone, or you have something that doesn't necessarily fit into your IRA or either one of your 401ks. So,
and
awesome.
Again, thanks for having us on, Andrea and the team in Houston. And remind me, you have offices in Dallas and San Antonio, not Austin?
Austin, Dallas, and Houston.
Okay, the 3. Got it.
Yes, but thank you so much, guys. That was music to my ears. I love Quest 2 and self-directed IRAs, and we'll be happy to assist anybody who has questions or needs help with the process or anything at all. We're here to help you guys. Thanks again, John and Patrick and everybody who joined us today and who participated. I hope everybody has a great rest of your weekends.
Good luck. Happy Thanksgiving, everyone.
See you guys.
Thank you so much. Bye-bye.